So, we've talked about different types of investing, different things to invest in. And, now we kind of want to put it all together and build a profitable portfolio because a well diversified portfolio is going to be vital to your success, right? As an individual investor, you kind of need to know how to determine an asset allocation that best fits your personal investment goals and risk tolerance. Your portfolio should meet your future capital requirements and give you peace of mind while doing so. Investors can construct portfolios aligned to investment strategies by following in my opinion, a pretty simple, systematic approach. And I kind of want to go over a couple steps that'll help you do that. So, one of the first things that we need to talk about is determining your appropriate asset allocation. Because ascertaining your individual financial situation and goals is your first task. Important items that you need to think about are age and how much time you have to grow your investments, as well as the amount of capital to invest and future income needs. What an unmarried 22-year-old college graduate, all of his goals and money that he has is going to be completely different than a 55-year-old married person. It's just you're in different situations. A second factor to consider is your personality and risk tolerance. Um, are you willing to hazard the potential loss of some money for the possibility of greater returns? Everyone would like to reap higher returns year after year, but if you can't sleep at night when your investments take a short-term drop, chances are, high returns from those kind of assets aren't going to be worth the stress. Clarifying your current situation, your future needs for capital, and your risk tolerance will determine how your investment should be allocated among different asset classes. The possibility of greater returns comes at the expense of greater risk of losses. High risk, high reward. And you don't want to eliminate risk, but you more want to optimize it for your individual situation and lifestyle. The young person who won't have to depend on his or her investments for income can afford to take greater risk in the quest for high returns. On the other hand, the person nearing retirement needs to focus on protecting their assets and drawing income from these assets in a tax efficient manner. We've talked about conservative and aggressive investors. The more risk you can bear, the more aggressive your portfolio can be, devoting a larger portion to equities and less to bonds and other fixed income securities. Conversely, the less risk you can assume, the more conservative your portfolio will be, right? The main goal of a conservative portfolio is protect its value. The allocation, you know, you know, it should yield, good enough income to let it grow and not take, substantial losses and provide some long-term capital growth potential, from the investment in the high quality equities. Um, the next thing, though, we're going to be talking about actually doing the portfolio, right? Setting it out. Because once you've determined the right asset allocation, you actually need to divide up your capital between the appropriate asset classes. And on a basic level, this is pretty simple. Equities are equities and bonds are bonds. But you can further break this down into different asset classes and subclasses, which have different risk and potential returns. As an example, an investor might divide the portfolio's equity portion between different industrial sectors and companies of different market capitalizations, and between domestic and foreign stocks. The bond portion might be allocated between those that are short term and long term, government debt versus corporate debt, so on and so forth. There are several ways you can go about choosing the assets and securities to fulfill your asset allocation strategy. Stock picking. Choose stocks that satisfy the level of risk you want to carry in the equity portion of your portfolio. Sector, market cap, and stock type are factors to consider. Analyze the companies using stock screeners to shortlist potential stocks. They carry out more in depth analysis on each potential purchase to determine its opportunities and risk going forward. This is the most work intensive means of adding securities to your portfolio, and it requires you to regularly monitor price changes in your holdings and stay current on company and industry news. Then there's bond picking. And when choosing bonds, there's several factors considering, right? The maturity, the bond type, the credit rating, as well as the general interest rate environment. And then we've got mutual funds. And mutual funds are available for a wide range of asset classes and allow you to hold stocks and bonds that are professionally researched and picked by fund managers. of course, fund managers charge a fee for their services, which are going to take away from your returns. But index funds present another choice because they tend to have lower fees because they mirror an established index and they're passively managed. And we can't forget about ETFs, exchange traded funds, because if you prefer not to invest with mutual funds, ETFs, they're going to be a good alternative. And they're essentially mutual funds that trade like stocks. They're, similar to mutual funds in that they represent a large basket of stocks, usually grouped by sector, capitalization, country, and stuff like that. But they differ in that they're not actively managed, but instead they track a chosen index or another basket of stocks. Because they're passively managed, ETFs offer cost savings over mutual funds while providing diversification. ETFs also cover a wide range of asset classes and can be useful for rounding out your portfolio. And then the next step we're going to talk about is, your portfolio weightings because, once you've established your portfolio and you put your money into it and it's kind of growing a little bit, you need to analyze and rebalance it periodically because changes in price movements might cause your weightings to change. And to assess your portfolio's actual asset allocation, you need to quantitatively categorize the investments and determine their values proportion to the whole. The other factors that are likely to alter over time are your current financial situation, your future needs, and your risk tolerance. If these things change, you may need to adjust your portfolio. And if your risk tolerance has dropped, you may need to reduce the number of equities held. Or perhaps you're ready to take on more risk and your asset allocations require a small portion of your assets be held in more volatile small cap stocks. To rebalance, determine which of your positions are overweighted and which ones are underweighted. As an example, say you're holding 30% of your current assets in small cap equities, while your original asset allocation suggests you should only have 15% of your assets in that class. Well, rebalancing involves determining how much of this position you need to reduce and allocate to other classes. Then one of the last steps to talk about is when you do this rebalancing, make sure you're doing this strategically. Because once you've determined which securities you need to reduce and by how much, you need to decide which underweighted securities you will buy with the proceeds from the selling of the overweighted securities, right? Uh, Perhaps your investment in growth stocks has appreciated strongly over the past year, but if you were to sell all of your equity positions to rebalance your portfolio, you may incur significant capital gains tax. In this case, it might be more beneficial to simply not contribute to any new funds to that asset class in the future while continuing to contribute to other asset classes. Now, this will reduce your growth stocks weighting in your portfolio over time without incurring capital gains tax. At the same time, always consider the outlook of your securities. If you suspect that those same overweighted growth stocks are ominously ready to fall, you may want to sell in spite of the tax implications. Analyst opinions and research reports can be useful tools to help gauge the outlook for your holdings. And, tax loss selling or tax loss harvesting is a strategy you can apply to reduce your tax implications. And with all this said and done, what have we even learned? Like, what's the lesson here? Okay, throughout the entire portfolio construction process, it's going to be vital that you remember to maintain your diversification above all else. It is not enough simply to own securities from each asset class. You must also diversify within each class. Ensure that your holdings within a given asset class are spread across an array of subclasses and industry sectors. Right? As we talked about, investors can achieve excellent diversification by using mutual funds and ETFs. These investment vehicles allow individual investors with relatively small amounts of money to obtain the economies of scale that large fund managers and institutional investors enjoy. So, hopefully, now that we've kind of talked about the different ways to invest, the different things you can invest in, and how to actually build your portfolio, I really hope this is going to help you on your journey to either get started investing or, help, in your current situation of investing, maybe improve it. But I really hope you guys actually just enjoyed the video. And if you did, I'd really appreciate it if you hit that thumbs up button. If you're subscribed to the channel, I appreciate it. If you're not subscribed to the channel, please do. But until I see you guys in the next one, y'all be safe.